If you can predict exactly how your costs move when output changes, you can see profit trouble coming long before it hits the income statement. Cost behavior is the idea that different costs react differently when activity rises or falls, and exam questions love testing whether you really know which cost does what. Start with fixed costs. These are the costs that in total stay about the same for a given period, no matter whether you produce a few units or a lot, as long as you stay within a normal activity range. Think of factory rent or a manager's monthly salary. You pay the full amount for the month, whether you make 100 units or 1000, so total fixed cost is flat for that period. But here's a key twist. Fixed costs are tied to time. So if you look at a longer period, like a year instead of a month, the total fixed cost grows because you are stacking more identical months together. That time link is why in management accounting we often call fixed costs period costs, because we think of them as belonging to a particular month, quarter, or year rather than to each unit produced. Not all fixed costs are perfectly flat though. A step fixed cost stays constant only up to a certain output level, then jumps to a new higher fixed amount once you cross a critical point. Imagine you need one supervisor for up to 20 workers. But if you hire worker number 21, you must hire a second supervisor. So the supervision cost graph looks like a staircase rather than a straight flat line. Now switch to variable costs. These move directly with output, so if you double production, total variable cost doubles, but the cost per unit stays the same at each activity level. A simple example is direct materials. If each unit uses $5 of materials, then making 10 units costs $50 of materials, and making 50 units costs $250, all at the same $5 per unit. Sometimes variable costs are not perfectly straight line, and we call these nonlinear or curvilinear variable costs because the total cost curve bends instead of forming a simple straight diagonal. In curvilinear behavior, each extra unit of output might add less cost than the previous one or more cost than the previous one, so the change in total cost is less than or more than proportionate to the change in volume. Many real-world costs are semi-variable, also called mixed costs, because they contain a fixed part that you pay regardless of activity and a variable part that grows with each extra unit produced. A typical example is a phone or electricity bill with a standing charge plus a per unit usage charge. The standing charge is the fixed component, while the usage charge is the variable component that rises with activity. There are other patterns too, such as a cost that is variable with output but capped at a maximum total amount, or a cost that is variable but includes a minimum fixed charge that you must pay, even if activity is very low. For instance, imagine a royalty fee that is $10,000 when sales are below 5,000 units, and then increases to $15,000 once you pass that 5,000 unit breakpoint, creating a jump in the cost level at that point. Here is the catch for unit costs. When output rises, the variable cost per unit stays constant, but the fixed cost per unit is spread over more units, so it falls, pulling the total cost per unit down as volume grows. To analyze cost behavior in practice, we usually assume that within a relevant output range, we can treat costs as fixed, variable, or mixed, that departmental costs are mixed, and that these mixed costs change in a straight line way with activity. That straight line assumption is what methods like the high-low method rely on, because they estimate the fixed and variable parts of a mixed cost using 2 points on a line within that normal activity range. Let's lock this in with a worked example using a product called a Z. Each Z has a variable production cost of $5 and the business carries total fixed costs of $5,000. If you only produce one Z, total variable cost is $5 and total fixed cost is still $5,000, so total cost is $5,005. On a per unit basis, at 1 unit, the variable cost per Z is $5 and the fixed cost per Z is $5,000, giving a massive total cost per unit of $5,005. Now increase output to 10 Zs. Total variable cost rises in proportion to $50, fixed cost stays at $5,000, and total cost becomes $5,050. At 10 units, the variable cost per unit is still $5, but the fixed cost per unit drops to $500. So total cost per unit falls sharply to $505. Push output further to 50 Zs, total variable cost climbs to $250, fixed cost remains $5,000, and total cost is now $5,250. At 50 units, the variable cost per Z is still $5, but the fixed cost per Z has fallen to $100, so the total cost per unit has dropped again to $105. This Z example shows the core cost behavior pattern. Total variable cost rises in line with output. Total fixed cost stays constant for the period. Variable cost per unit is flat. Fixed cost per unit falls and total cost per unit declines as volume increases. When you see a cost in an exam or at work, ask yourself first, is it fixed, variable, step fixed, or mixed, and how will it behave as output changes? Because that thinking is what leads to correct budgets and profit forecasts. Subscribe if you want the next lesson to walk through splitting mixed costs step by step and applying the high-low method, so each new video moves you closer to passing CPA Management Accounting with confidence.